Alibaba just reported their latest quarterly earnings. It was a beat. The stock is up 2 to 3% as you can see, but the results weren't super exciting. But since Alibaba is trading at, well, pretty low levels, as you can see here with regards to valuation, forward PE, EV to EBITDA, price to sales, price to free cash flow, I mean, in the last 12 months, price to free cash flow here, 7.8 times, is ridiculously cheap for a company of Alibaba's size, just under $200 billion. Now, of course, we know there is China risk. There is a lot of controversy around investing in Chinese companies. There's a lot of controversy around government controlling Chinese companies. I know we've talked about this plenty of times, but we also talked about the other side. The fact that companies like Pinduoduo, for example, it has performed quite well in 2023. The stock was up, I think, 75-80% or so. So there's definitely demand, or at least there are people that are willing to invest in Chinese companies, especially those that are growing quite fast, because we did know that Pinduoduo is taking market share. We do know that Pinduoduo is growing faster than Alibaba. But that said, when you look at these valuation metrics, you cannot tell me that this does not scratch a little itch when it comes to, it does look cheap. Now, currently, if we look at what the analysts are expecting for the coming fiscal years, they are basically expecting mid to high single-digit growth with regards to sales and EPS. For fiscal year 2025, sales growth of 8.35% year over year and EPS growth of just 6.29%. With regards to 2026, a bit of the same, but with EPS growing a little bit faster at 8.5% year over year. So maybe that's also one of the reasons why currently this stock is not trading at a higher multiple. And as I'm saying this, the stock is now down 1% before the market opens. Of course, prices will fluctuate throughout the day. But as I said at the start, they did beat, but the numbers weren't incredible, as you will see in just a second. If you enjoy this type of videos, give it a thumbs up, subscribe if you have not, really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/calcininvestor. Thank you very much. So let's first start with a couple of comments here. We delivered a solid quarter as we are executing our focus strategies across the organization. Our top priority is to reignite the growth of our core business, e-commerce and cloud computing. This is something that they've mentioned quite a lot recently. We will step up investment to improve users' core experiences to drive growth in Taobao and Tmall Group and strengthen our market leadership in the coming year. We will also focus our resources on developing public cloud products and sustaining this strong growth momentum in the international commerce business. With regards to the CFO, he says here, with regards to the share buyback program, our board of directors approved an increase of $25 billion to our share repurchase program, demonstrating our confidence in the outlook of our business and cash flow. Now, of course, the next step would be buying back as many shares as you can if you truly think that your business is undervalued. With regards to that specifically, as of December 31st, 2023, they had 20 billion ordinary shares, equivalent of 2.5 billion ADS outstanding. Our share repurchase program resulted in a net reduction of 3.3% in our outstanding shares in the 2023 calendar year after accounting for shares issued under our ESOP. And with the increase of $25 billion, they currently have $35.3 billion available under their share repurchase program through the next 3 fiscal years. And we know that their market share is under $200 billion. They now still have $35 billion worth of share repurchases to do in the next coming fiscal years. It's quite a lot of shares that they can remove from the public markets. Now, looking at each segment and their performance. So, Taobao and Tmall Group, the largest segment for them, that increased 2% year over year. The cloud segment, only 3%. Again, you see, this is a company that is supposed to grow faster, right? It's supposed to grow faster than what we're seeing right now. Only 2% for the largest group and 3% for the cloud, in my opinion, is not enough. Internationally has always been performing quite well. So Alibaba International Digital Commerce Group, up 44% year over year. Logistics network, 24% growth year over year. Local services, 13%. Digital media entertainment, small segment, that's up 18% year over year. So overall, revenue is up 6%. But when we look at net income, income from operations, that's down 36%. and 77% respectively. That's because there's a huge increase here in amortization and impairment of intangible assets and impairment of goodwill and others. Basically an increase of $9 billion for the amortization one and around $7 billion for the impairment of goodwill. And by the way, this is Chinese currency, not USD. And so moving to cash flow, free cash flow for this quarter was $7.96 billion. They repurchased just under $3 billion worth of shares. With regards to cost of revenue and OPEX, we can see cost of revenue excluding SBC as a percentage of revenue still sits at 60%. Sales and marketing basically flat year over year. Basically every expense here is flat year over year. Yet they've been talking about becoming a bit more profitable, about growing a bit faster as well. Yet we're not really seeing cost cuts having any effects here. Then with regards to the difference in adjusted EBITDA year-over-year changes, we always do this, we compare it whether or not a segment has become a bit more profitable for them or not. So we know the growth for revenue across the segments as we've seen before. But with adjusted EBITDA, we can see here Taobao and Tmall Group has increased 1% year over year. Cloud segment has become much better, 86% growth year over year. International Group decreased 388% year over year. Logistics part basically went from negative to positive. Local services increased 29%. Digital media entertainment decreased 32%. Then all the others here, 87% decrease. Now with regards to Alibaba's Cloud Intelligent Group, they did say here that they continue to improve revenue quality by reducing the revenue from low margin project-based contract. On the other hand, revenue from public cloud products and services grew healthy, which contributed to profitability improvement. So there you have it. Then with regards to the international segment, so they say here that AliExpress delivered over 60% year-over-year order growth driven by choice, which provides an enhanced experience to customers by combining better product selection, price and quality with speed of logistics and great customers. They say here that choice represented about half of AliExpress total orders in January 2024 and continues to deliver rapid order growth. With regards to Trendyol, continued its robust double-digit order growth while maintaining its leading e-commerce position in Turkey. With regards to Lazada, it continues to focus on optimizing its operating efficiency with further increased monetization and decreased logistics cost. Lazada's loss per order continues to narrow year over year during the quarter. Now, I do believe that I've seen some reports saying that maybe they might be willing to divest from Freshippo. Remains to be seen what happens with that. And so to conclude, we're now basically flat. Again, things can change extremely quickly when you're watching this video, but basically it does seem like we have bottomed at around $65, $66 or so. We're now over the 20 and the 50-day moving average. The 200-day one sits at around $83. So there's still a couple of dollars left for us to challenge that yet again. RSI still pretty neutral right now. There is a little bit of momentum with regards to Chinese stocks more recently because of, well, the reports that China might want to stimulate its economy to start growing yet again, which should definitely help a company like Alibaba. But remains to be seen what happens. I do think that 2024 will still be quite a volatile year with regards to Chinese stocks and the Chinese economy, but certainly something to keep an eye on, because if you have the risk capacity, let's say, to have Chinese stocks in your portfolio, there are definitely some good companies you can pick up at an insanely cheap price. Again, it all depends on what kind of investor you are. That's just my opinion. Of course, do share your down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.